People love to say, just let it compound, as if that sentence alone turns $100,000 into $1 million. It doesn't. Compounding is not a magic trick, it's an equation. And like any equation, it only gives you what you ask for if the inputs are sane. The fantasy version goes like this. You scrape together $100,000 once, throw it into the market, walk away, and somehow you wake up a millionaire. The real version is uglier, slower, and governed by arithmetic that does not care about your hopes, your politics, or how hard you think you work. The gap between those two versions is where most investors live, and it's exactly why so many of them die in the middle, somewhere between $100,000 and $300,000, stalled, disillusioned, and quietly blaming everything but their own behavior. If you want to know how $100,000 actually becomes $1 million, you don't need a guru. You need a blueprint that starts with mathematics and then straps human stupidity to the chair until the work is done. The blueprint is simple to describe and incredibly hard to follow. There are only 3 levers that matter: how much capital you start with, how much additional capital you add, and how long you leave it alone to earn a reasonable return without you interfering like an idiot. That's it. Everything else is marketing. The problem is that people lie to themselves about all 3. They overestimate returns, underestimate time, and destroy their own compounding with fees, debt, and panic. Let's start by killing the easiest delusion. I've seen people toss around numbers like 15% or 20% annual returns as if they're just a matter of picking the right sector. Sure, you can get 20% in a given year. You might even luck into a short stretch of above-average gains. But 20% per year for decades is fantasy territory reserved for a handful of extraordinary businesses and a few lucky or brilliant professionals who also endured gut-wrenching drawdowns along the way. It is not a planning number for normal people, especially not for a man in his 50s hoping to salvage his retirement. If you build your life around fantasy returns, you are not an investor. You are a gambler with a spreadsheet. Be conservative. If you own a broad basket of productive businesses in a decent economy, you might reasonably expect 7-8% nominal annual returns over long stretches before inflation bites. After inflation, your real return is lower, maybe 4-6%. That's the speed limit of reality. So when you hear someone gush that $100,000 at 20% for 20 years becomes $3.8 million, file that under lottery ticket daydreams, not retirement math. The Munger way is to start with assumption sets that won't kill you if they're wrong. If you're pleasantly surprised, fine. If you're not, at least you're not bagging groceries at 75 because your spreadsheet lied to you. Now look at what a sober assumption actually does. Take $100,000 and let it grow at 7% a year with no additional contributions. In 20 years, that becomes about $387,000. In 25 years, around $543,000. In 30 years, roughly $761,000. Push the return to 8%, and in 30 years, you get close to $1 million. $100,000 turns into just over $1 million. If, and only if, you sit through 3 decades without blowing yourself up. That's the first reality check. At reasonable returns, turning $100,000 into $1 million without adding more money is a 30-year project. If you are 35 with $100,000, that might be fine. If you're 55, you'd better stop pretending you live in that scenario. Your runway is shorter, your mistakes are more expensive, and your fantasies are more lethal. Now look at what a sober assumption actually does. Take $100,000 and let it grow at 7% a year with no additional contributions. In 20 years, that becomes about $387,000. In 25 years, around $543,000. In 30 years, roughly $761,000. Push the return to 8%, and in 30 years, you get close to $1 million. $100,000 turns into just over $1 million if, and only if, you sit through 3 decades without blowing yourself up. That's the first reality check. At reasonable returns, turning $100,000 into $1 million without adding more money is a 30-year project. If you're 35 with $100,000, that might be fine. If you're 55, you'd better stop pretending you live in that scenario. Your runway is shorter, your mistakes are more expensive, and your fantasies are more lethal. The point is not to depress you. It's to anchor you in the only world that matters, the one with calendars and mortality. If you are 45, 55, 65, you do not get to use the same compounding tables as a 25-year-old. The math of $100,000 to $1 million is chainsawed by time. You will either compensate with higher contributions, accept a smaller final number, or take idiotic risks that feel smart until the moment they don't. You get to choose which. That brings us to the second lever, how much additional capital you add. This is where the blueprint becomes powerful for normal people and not just lucky 20-somethings. Because while you cannot command the market to give you 15% returns, you can absolutely command yourself to add another $5,000, $10,000, or $20,000 each year to that $100,000 base. And the arithmetic of that decision is staggering in both directions. Run a simple case. You have $100,000. You invest it sensibly and expect 7% a year. On its own, in 20 years, as we said, you end up around $387,000. Now imagine that. Instead of congratulating yourself and coasting, you keep saving $10,000 every year and adding it to the same boring compounding machine. The future value of that stream of contributions over 20 years at 7% is roughly $410,000. Add the $387,000 from the original $100,000 growing, and you're sitting near $800,000. Extend that discipline to 25 years, and the contribution stream alone grows to over $630,000, while your original $100,000 becomes about $540,000. You've crossed $1.1 million without doing a single clever thing other than not quitting and not upgrading your lifestyle every time you get a raise. Now alter the knob again. Bump the yearly contribution from $10,000 to $15,000 or $20,000, and the timeline compresses dramatically. At 7%, with $100,000 already in place, saving $20,000 a year gets you into seven-figure territory in less than 2 decades. At that point, the limiting factor is not the market. It's your willingness to live below your means and tolerate boredom, while numbers you can't touch accumulate in accounts you rarely talk about. But notice what this blueprint demands from you psychologically. In the early years, it still feels like nothing. Your $100,000 earns $7,000 the first year at 7%. Add your $10,000 and you're at $117,000. That's not life-changing. 2 years later, maybe you're $125,000 or $130,000. You could vaporize that with one stupid car purchase. That's precisely why so many people walk away. The rewards at the beginning are too modest to overcome their ego and envy. They see neighbors buying toys, colleagues posting vacations, and they can't stand being the one who can afford more but chooses not to. So they abandon the contributions or raid the account or start swinging for the fences in the market to make the line go up faster. In other words, they tear up the only blueprint that ever had a chance of working. For men who are already in midlife, the costs of that kind of quitting are savage. Imagine a 50-year-old with $100,000 saved and 15 working years left before a theoretical retirement at 65. If he adds $15,000 a year at 7%, his $100,000 grows to about $276,000 over those 15 years. His stream of $15,000 contributions grows to roughly $377,000. Put together, that's something like $650,000. Not enough to buy a private jet, but a very real buffer against old age poverty. Increase the yearly savings to $20,000 and the total crosses comfortably into the $800,000 cess. Conversely, convince yourself it's too late, add nothing, and just let the $100,000 sit. You arrive at 65 with roughly $276,000 and a problem you can't fix anymore. This is where inversion becomes non-optional. Don't just think, how do I get from $100,000 to $1 million? Ask, how do I almost guarantee that my $100,000 never becomes $1 million? That list is short and ugly. Assume fantasy returns so you undersave. Pay high fees so the market's return is quietly siphoned away. Trade constantly so taxes gut whatever gains you do make. Borrow against your capital so a routine downturn forces you to liquidate at the worst moment. Inflate your lifestyle with every pay raise so there's never any cash left to add to the pile. Panic and sell in the inevitable bear markets. Repeat these habits for a decade or two, and you will have turned a perfectly adequate blueprint into scrap paper. The blueprint itself is not complicated. Mathematically, $100,000 becomes $1 million through some mix of 3 ingredients: time, return, and fresh capital. The Munger twist is to set conservative expectations on return, be brutally honest about how much time you actually have, and then squeeze your behavior for as much fresh capital as your pride will tolerate, while ruthlessly eliminating anything that risks a catastrophic loss. You don't need brilliance for that. You need the humility to admit you are not special, and the discipline to behave like someone who understands that. If you accept that, then the rest of the discussion is about subtracting stupidity. How do you strip away the behavior that sabotages every one of those levers? How do you keep your 7? 8% before inflation returns from turning into 3. 4% after fees and taxes. How do you stop yourself from grabbing at every shiny investment that promises to accelerate the process while really just resetting you to 0? How do you structure your life so that adding $10,000 or $20,000 a year to your capital is not a heroic act, but simply what happens by default? In other words, how do you actually live the blueprint instead of daydreaming about it? That's where most people fail, and it's where we'll stay for a while. Because if you don't understand how the common failure modes work, you will walk right into them. The arithmetic is happy to make you rich if you'll stop sabotaging it. The market doesn't have to beat you. Your own habits will do the job if you let them. The first and most reliable way to wreck the blueprint is fees. People will argue for weeks about whether the market will return 7% or 8% and then hand away 1. 2% of whatever it does give them to intermediaries without a second thought. At 7% gross, a 1% annual fee cuts your return to 6%. That doesn't sound like much, it sounds like noise. Over a year, it's almost invisible. Over the trip from $100,000 to $1 million, it's a meat grinder. Run the numbers. At 7% with no fees, $100,000 left alone for 30 years becomes about $761,000. At 6%, it becomes roughly $575,000. 1 percentage point siphoned off every year just cost you nearly $200,000. Now remember, most people are also adding new money along the way. Suppose you start with that $100,000 and add $10,000 a year for 25 years. At 7%, you end up around $1.1 million. At 6%, you end up around $950,000. That tiny 1% fee cost you roughly $150,000, enough to buy you years of dignity in old age. You would not tolerate a stranger stealing $150,000 from your account in one night. But spread it over a few decades and call it management, and suddenly it feels sophisticated. Taxes do the same thing from a different angle. Every time you insist on doing something with your portfolio, selling winners because you're nervous, jumping in and out of funds, chasing the sector of the month, you are not just paying commissions and spreads. You are inviting the government to take a permanent cut of what could have continued compounding for you. Short-term capital gains are taxed at your ordinary income rate. For high earners, that can be well over 30%. Even long-term gains cost you 15%, 20%. Pay that every year, and you've effectively volunteered to share your compounding with the tax man for the rest of your life. Consider two investors with $100,000 each. Both earn the same 7% before tax and fees. One buys a low-cost index fund, adds $10,000 a year, and touches nothing for 25 years. His trades are minimal, his taxes deferred. The other manages his money, turning the portfolio over every year, realizing gains, paying his 20% long-term tax, plus an extra 1% in various costs. On paper, they live in the same market. In reality, the second man's effective return might be closer to 5% after friction. The first ends up, as we said, near $1.1 million. The second limps in around $730,000. Same starting point, same market, same contributions. The difference is not luck. The difference is self-inflicted wounds. Older investors have even less room for that kind of stupidity. A 30-year-old who wastes a decade in high-fee funds and frenetic trading can still course-correct and spend the next 30 years letting low-fee compounding work. A 55-year-old who repeats the same mistake doesn't have another 30-year runway. When you're on your final serious compounding window, you cannot afford to share 30% of your potential gains with salesmen and the IRS because you're bored. The blueprint from $100,000 to $1 million assumes the engine is actually receiving most of the fuel. If you punch holes in the tank with every trade and every strategy upgrade, don't act shocked when you run out of gas halfway up the mountain. If fees and taxes are slow leaks, leverage is dynamite. Nothing accelerates the destruction of a blueprint like borrowing against your capital to chase higher returns. It looks brilliant on the way up, right until it doesn't. The logic goes like this. If my investments are compounding at 7, 8%, why not use cheap debt at 3, 5% to buy more? I'll pocket the spread. What this cheerful little story ignores is that markets do not pay you in a straight line. They stagger, they crash, they humiliate the overconfident. If you are 25 and blow up a $10,000 leveraged account, it's a painful lesson. If you are 55 and blow up a $300,000 levered portfolio, it might be the last real lesson you can afford. Picture a 55-year-old with $100,000 on margin at 2-1 leverage. $100,000 of his own money, $100,000 borrowed. He's lulled by a decade of rising markets into thinking this is conservative. Then we get a perfectly normal 35% bear market. His $200,000 position falls to $130,000. The broker still wants its $100,000 back. Our genius is left with $30,000. 30 years of careful saving detonated in one cycle because he wanted to make his money work harder. To get back to $100,000 from $30,000, he now needs a 233% gain, and he is 10 years older. The blueprint is not just delayed, it is shredded. You don't need margin for leverage to ruin you. Consumer debt is just leverage with worse collateral. Credit cards at 18. 25% interest or negative compounding strapped directly to your ankle. You borrow $10,000 for some shiny object, carry it on a card, and suddenly the market has to give you equity-like returns just to offset the drag of your own stupidity. A 7% portfolio return paired with 18% credit card debt is not a wealth strategy. It's a treadmill to nowhere. Yet people will proudly tell you about their investments while quietly hemorrhaging money on this kind of debt. If you are serious about turning $100,000 into $1 million, you do not carry balances that grow faster than your assets. That's inversion in practice. Don't invite a negative compounding machine into the same house as your positive one. The next wrecking ball is behavior in downturns. Markets will fall. If your blueprint assumes otherwise, you are already lost. The math from $100,000 to $1 million looks very different depending on whether you hold your nerve or sell in a panic at exactly the wrong time. Here's a simple example. You're 50 with $100,000 invested, planning to add $15,000 a year for the next 15 years. Then you get your first serious bear market. Your portfolio falls 35%. On paper, you are down to $65,000. If you do nothing, keep contributing, keep buying, let the market heal, you will almost certainly recover and more. The lower prices on your contributions actually help your future returns. But if you panic and sell out to wait for clarity, you lock in the loss, stop the compounding, and almost always miss the sharpest part of the rebound. This is not hypothetical. In the 2008-2009 crisis, countless investors sold near the bottom, sat in cash while the market recovered, and only crept back in years later. The long-term return of the index from 2007 through the next decade was fine. Their personal return was not, because they experienced all the pain and almost none of the recovery. That behavior takes your tidy 7. 8% planning number and turns it into 3. 4% or worse. It stretches the timeline from $100,000 to $1 million out into the future until it intersects with your own mortality. You cannot compound what you panic sell. The only way around this is to build the blueprint with volatility in mind from the start. That means 2 things. First, you pick an allocation you can live with in a 50% drawdown without doing something idiotic. If 100% stocks will cause you to sell everything when the market is down 40%, then you have no business being 100% in stocks. Take less theoretical return if it buys you enough emotional stability to actually stay in the game. Second, you explicitly decide in advance what you will do in a crash. Not I'll see how I feel, but if the market falls 30%, I will continue my contributions exactly as planned, and if anything, buy a little more. The time to write that rule is on a quiet Sunday, not in the middle of a screaming headline. All of this sits on top of a more mundane but deadly enemy, lifestyle inflation. The blueprint from $100,000 to $1 million is fueled by surplus, the gap between what you earn and what you spend. If that gap closes every time your income rises, the blueprint starves. It doesn't matter if your investments double every decade if you never add a meaningful amount to them. High earners are especially vulnerable here. A man making $200,000 a year who saves 5% is not doing great. He is functionally poorer than a man making $80,000 who saves 25%. The first will brag about his paycheck, his house, his car. The second will quietly accumulate real capital. If you've already reached $100,000 and you want to reach $1 million in any reasonable time frame, you treat raises and windfalls as fuel for the blueprint, not as permission slips to consume more. Your goal is to widen the savings gap every few years, not maintain it. If you were saving $10,000 a year on a $70,000 income, then get a raise to $90,000 and keep your lifestyle almost the same, you can now save $25,000 or more. That choice alone can shave years off the journey to $1 million. But most people do the exact opposite. Their expenses swell to fill the new income. The gap stays the same or even narrows. 20 years later, they wonder why their net worth doesn't reflect their lifetime earnings. That's the opportunity cost problem at the heart of this. Every decision to upgrade consumption is a decision to downgrade future capital. The couple that spends an extra $1,000 a month because we can is not just out $12,000 a year. At 7% over 20 years, that $12,000 yearly could have compounded into roughly $500,000. They literally traded $500,000 of future options for a bigger kitchen and nicer dinners. They will never see the bill itemized like that, so they convince themselves it was no big deal. The math quietly disagrees. Layered on top of all these mistakes is a final toxic mix Munger would call a Lollapalooza effect. Several bad tendencies combining to produce truly stupid outcome. Take an investor with $100,000 at 50. He feels behind, so he's impatient. His peers are flashing wealth on social media, so he's envious. Advisors and marketers are promising alternative strategies with high returns, so he's tempted by complexity. Rates are low, so leverage feels safe. He hates feeling bored, so steady indexing seems too slow. That cocktail leads straight to disaster. Leveraged bets on opaque products, high fees, high turnover, and panic exits at the first sign of trouble. On a spreadsheet, he's projecting $100,000 to $1 million in 15 years. In reality, he's projecting $100,000 to $40,000 and another decade of work he didn't think he'd need. This is why the Munger blueprint is so obsessed with subtraction. You don't start by asking, what can I add to juice my returns? You ask, what can I remove so I stop stabbing my own compounding machine? High fees, excessive trading, leverage, undisciplined lifestyle creep, complexity outside your circle of competence, media diets that feed fear and envy. These are not minor flaws. They are the exact reasons most investors never make the full jump from $100,000 to $1 million, no matter how loudly they talk about compounding. Once you've stripped away those forms of stupidity, what's left begins to look almost insultingly straightforward. A pile of capital earning a realistic return, consistently fed with new contributions, protected from catastrophic loss and emotional interference. It isn't sexy, it isn't fun at parties, but it works. The remaining question, the only question worth asking, is how to turn that plain structure into something you will actually follow for 20 or 30 years, through crashes, fads, and your own changing life. That's not a matter of discovering a secret. It's a matter of committing to a few brutally simple rules and refusing to break them, even when every instinct in your body screams that this time is different. What does that commitment look like in practice, especially if you're starting in midlife with less time than you'd like and more mistakes behind you than you care to admit? Looks like a set of non-negotiable constraints, hard lines you do not cross, regardless of mood, market, or social pressure. The exact content of those rules, tailored to the journey from $100,000 to $1 million, is where the blueprint ceases to be abstract and becomes a contract. You're not making that contract with the market. You're making it with your future self, and only one of you gets a vote on whether it's honored. A contract worth anything has to be specific. I'll save more is not a rule. I'll be smarter is not a rule. Those are lies we tell ourselves to get out of real commitments. A real blueprint from $100,000 to $1 million lives in sentences that can be tested as true or false. Either you kept them or you didn't. So write them the way an engineer would, not the way a motivational speaker would. The first clause is simple. No leverage. None. No margin in your brokerage. No securities-backed loans because the banker smiled and said it was safe. No borrowing against your portfolio to juice, returns, or fund consumption. If you're still on the path from $100,000 to $1 million, you have not yet earned the right to play games with debt. Your job is to stack chips, not borrow against the few you have. The entire logic of compounding works only if your downside is survivable. Leverage turns routine volatility into potential ruin. You don't need to be a genius to avoid ruin. You just need the discipline to walk away from the shiny, dangerous buttons. The second clause, no high interest debt, period. You do not carry balances on credit cards while talking about your investments. You do not finance toys at double-digit rates while fantasizing about compounding. You kill those balances first because they are negative compounding machines running in the background. A 7% return on your $100,000 does you no good if you're paying 18% on $20,000 of revolving debt. Before you worry about turning $100,000 into $1 million, make sure you're not quietly turning $1 million into $100,000 in reverse. Third, cap your friction. Total investment costs, fund expenses, advisory fees, trading costs should be well under 1% of assets per year. If you can get them under 0.3%, better. This is not negotiable. If an advisor, fund, or strategy requires more than that, they are asking to stand between you and your own compounding. Say no. Most of the time, the simplest answer is to own low-cost index funds and stop trying to be clever. The market's return is good enough if you actually receive it. Fourth, set a contribution floor and treat it like rent you owe your future. From $100,000 to $1 million, your yearly additions are not optional extras. They are the main driver of the outcome, especially if you are starting in midlife. Decide on a number you will add every year. $10,000, $15,000, $20,000, whatever your income and age demand. And then make it automatic. If your income rises, you raise the floor, not your lifestyle. If your income falls, you cut consumption, not contributions, until you have no other choice. The dollar amount is less important than the fact that it happens every single year, through good moods and bad, through bull markets and bear markets, without renegotiation. Fifth, choose an allocation that you can live with in a real drawdown and write it down. If you decide you are 70% in equities, 30% in safer assets, that is the plan. You do not suddenly become 0% equities because headlines scared you. You do not become 100% equities because you got greedy. You rebalance to your target like a machine, not like a gossip. That target should reflect two things: your time horizon and your stomach. At 40, with decades ahead, you might justifiably lean heavily into stocks. At 60, with fewer years to recover, you may need more ballast. The blueprint does not require a specific mix. It requires that you pick one that your emotional circuitry can tolerate when, not if, the market drops 30. 50%. Sixth, lock in your circle of competence. If you cannot read a set of financial statements and understand how a company makes money, you should not be hand-picking individual stocks with your retirement base. Own broad funds. If you insist on stock picking, cage it. 5 or 10% of your portfolio devoted to names you truly understand is enough. The rest belongs in diversified, boring vehicles. Remember that the question is not, could I pick winners? The question is, do I need to pick winners to reach $1 million? The math answers that for you. You don't. A 7. 8% compounded base plus consistent contributions already does the job. 7th, write your crash protocol while the sun is shining, on one sheet of paper. In plain language, state what you will do when your portfolio is down 20%, 30%, 40%. Not what you hope you'll do, what you will do. Something like, if the market falls 30%, I will not sell anything. I will continue contributions as usual. If prices remain depressed, I will add extra if possible. Sign it. Show it to someone whose opinion you respect when the crash comes. And it will. You read that document instead of your newsfeed. You follow your own instructions instead of your fear. 8th, outlaw lifestyle creep. From $100,000 to $1 million, any significant increase in income should primarily improve your balance sheet, not your furniture. Make a rule. For every extra dollar of income, at least half goes to increase saving and investing, not spending. If your salary jumps by $20,000, your yearly contribution doesn't stay flat. It jumps by at least $10,000. This is how the gap between $100,000 and $1 million compresses from maybe in 30 years. to maybe in 12 or 15. Without that rule, raises are just opportunities to buy more liabilities and complain later. Ninth, treat complexity as a red flag. If you don't understand an investment within a few minutes of reading about it, you do not buy it with capital you can't afford to lose. I don't care if it's a derivative, a crypto token, a structured product, or someone's exclusive fund. The world is full of instruments designed to transfer money from the impatient and ignorant to the patient informed. When in doubt, assume you are in the first group. Remember, you do not get extra points for making your route to $1 million ornate. You get paid for arriving with your capital intact. 10th, protect your environment. You cannot follow this blueprint while bathing your brain in noise. The more you watch financial television, scroll forums, and consume prediction porn, the more likely you are to override your own rules out of excitement or fear. Set limits. Maybe you check your portfolio once a month. Maybe you read one serious annual report or book each quarter instead of 20 breathless blog posts. The less stimulation you invite, the easier it is to behave like a long-term owner instead of a jittery speculator. For a man in his 40s, 50s, or 60s, these constraints are not overkill. They are the minimum guardrails necessary to keep time and compounding on his side. Younger people can sometimes afford heroics and recover from their own idiocy. Older ones can't. When you have fewer earning years left, your greatest asset is not your cleverness. It's your ability to avoid one or two devastating mistakes. Turning $100,000 into $1 million at 25 might involve boldness. Turning $100,000 into $1 million starting at 50 almost always involves the opposite. Refusal to do anything that risks going backward in a way you don't have time to repair. Now put it all together. The Munger blueprint is this: assemble the first $100,000 by any honest means that don't destroy your health or integrity. Once you have it, stop thinking of it as a pile of money and start thinking of it as a small, fragile machine. Your job is to feed that machine regularly, protect it from damage, and let it run long enough. Reasonable return, plus steady contributions, minus big mistakes over sufficient time. That is the entire story. It is not exciting. It will never trend on social media. But the arithmetic will quietly march you toward $1 million while the world chases fads and resets to zero. Along the way, you will be constantly tempted to defect. You will be told you're too cautious. You will be told you're too late. You will be told this or that shortcut can accelerate your path. Remember inversion. Ask, if I adopt this new behavior, how specifically could it blow up my blueprint? If the answer is by wiping out half my capital in a bad year, or by doubling my fixed costs so I can't save, you have your decision. Say no. You don't need 10 ways to get rich. You need to faithfully execute one sane way and avoid 10,000 ways to blow yourself up. If you want a test of whether you're on that path, stop fantasizing and do one simple thing. Project your current behavior forward. Take your actual savings rate, your actual expected return after fees and taxes, and the actual years you have left until you'd like the option to stop working. Run the numbers. Does it get you from $100,000 to anything close to $1 million? If not, the blueprint is not broken. You are. Fix the inputs. Increase contributions. Cut friction. Reduce risk of ruin. Or accept a smaller destination and stop lying to yourself. The math is not emotional. It will not comfort you. It will simply tell you where you are headed. You can't negotiate with compounding. You can't charm it. You can't bully it. You can only cooperate with it or sabotage it. The Munger way is to remove as much sabotage as possible and then stand back. Do that, and $100,000 to $1 million is not a miracle. It's a long, slow, boring consequence of choices you made over and over when nobody was watching. Refuse, and you will spend the rest of your life mistaking occasional luck for progress and recurring disappointment for fate. The blueprint is on the table. Reasonable return, consistent additions, ruthless avoidance of stupidity, enough years. That's how $100,000 actually becomes $1 million. Not in a brochure, in the real world, with your name on the account and your future hanging on the line. The math doesn't lie. People do. Decide which side of that equation you want to be on.